Are you turning 73 this year or next? One small timing choice can force you to take two required withdrawals in the same year. That can raise your taxes and even your Medicare premiums later. In the next 10 minutes, I'll show you a simple way to avoid that 2-in-1 year tax hit and keep more control of your cash flow. I'm Mark Fonville, CEO of Covenant Wealth Advisors, where we help individuals with over $1 million in retirement savings retire with peace of mind through a lifetime of clarity, insight, and partnership. So if clear, tax-smart retirement guidance helps you, please like this video and subscribe so you never miss a weekly tip. Now let's start with the plain English basics. An RMD is a required minimum distribution. It is the minimum amount the IRS says you must withdraw each year from most tax-deferred accounts. Think traditional IRAs and many workplace plans. The required beginning date is the first date you must start RMDs. For most people today, that is April 1st of the year after you turn 73. So here is where many people get tripped up. Your first RMD is for the first calendar year you turn 73. You are allowed to delay that first one until April 1st of the following year. Sounds nice, but there is a catch. You still owe the second year's RMD by December 31st of that same year. That means two withdrawals in one calendar year. Two RMDs stacking on top of each other can push you into a higher tax bracket. It can also raise your future Medicare premiums through something called IRMAA. Now, IRMAA is a surcharge on Medicare premiums for higher incomes based on your tax return from 2 years earlier. Let's open a simple example so you can get a better understanding. Imagine you live in Virginia with an IRA worth $1.8 million on December 31st of last year. At age 73, the IRS table gives a distribution period of about 26.5. So your first RMD is around $67,900. If you delay that first RMD into next year, you will still owe next year's RMD by year end. At age 74, the factor is about 25.5. If your balance is similar, that second RMD might be around $70,000. That could be roughly $138,000 of taxable withdrawals in one calendar year, before any other income. That is the 2-in-1 year tax hit we are trying to avoid in the first place. Now, you might be thinking, why would anyone delay the first RMD? Well, a common reason is, I don't need the money this year, or I want to keep the account growing longer. Those are fairly natural thoughts, but ask this instead. Which year gives you the lower total tax bill and lower risk of a premium surcharge later? If taking one RMD this year and one next year spreads your income out better, that is often the cleaner path. Now, here's a little myth versus fact for you. The myth is delaying the first RMD always saves taxes. The fact is, delaying often creates two RMDs in 1 year, which can raise taxes and future Medicare premiums. Here's another myth for you. I can roll my RMD into a Roth to avoid tax. The fact is, RMD dollars are not eligible for rollover or conversion. You must take your RMD first. Conversions, if they make sense, come after. Now let's define a few terms as we go. MAGI stands for Modified Adjusted Gross Income. For Medicare, that is your adjusted gross income plus tax-exempt interest like municipal bond interest. IRMAA uses MAGI from 2 years earlier. So income you stack this year can raise premiums 2 years down the road. That is why doubling up RMDs can really sting you twice. Now, here's a quick checklist to help you choose your timing this week. First, confirm the year you turn 73. Second, estimate your other income from this year and next year. Look at Social Security, pensions, interest, dividends. Third, add a rough RMD estimate. You can divide last December's 31st balances by the IRS factor for your age. Fourth, compare the two paths. Path 1 is one RMD this year and one next year. Path 2 is delay the first RMD to next year and take two next year. Which path keeps your total income lower in each year? Fifth, Remember Medicare, if you pile income into next year, that can raise premium 2 years later. Avoid cliff jumps when you can. Here is just a fast story from a hypothetical couple in Williamsburg. So they have $2.1 million delayed the first RMD because they did not need the money. The next year, they sold a rental property. That created large capital gains on two RMDs. Their taxes jumped. 2 years later, their Medicare premiums also jumped due to IRMAA. So could they have avoided it? And the answer is yes. By taking the first RMD in the original year, they would have split the income across 2 years and stayed below the next threshold. Well, what if you were still working at 73? Some employer plans allow what is called the still working option. If you are not a 5% owner and the plan allows for it, you can delay plan RMDs until after you retire. This does not apply to IRAs. Now, you'll want to be sure to speak with your plan to confirm the rules or your financial advisor, but for many high earners in Virginia and across the United States who are still working, using the plan's exception and consolidating old balances into the active plan can reduce required withdrawals during your working years. So let's talk about which accounts you can combine for RMDs. IRA rules allow aggregation. And that means you can calculate the RMD for each IRA. Then you can take the total from any one or more of your IRAs. Workplace plans are different. Each 401k generally must pay its own RMD from that plan. 403b plans, however, can usually aggregate with other 403b accounts, but not with IRAs. This one detail trips up a lot of folks. Missing one plan's RMD can trigger an excise tax. The current penalty is 25% of the shortfall, reduced to 10% if you fix it in time. So do not count on a waiver. Set reminders right now. Now, another practical piece is taxes withheld. By default, IRA withdrawals often withhold 10% federal tax unless you choose a different number. You can change withholding with a simple form. Some retirees in Richmond take their RMD, for example, late in the year and set withholding high enough to cover much of their total tax. That can help with estimated tax penalties because withheld tax is treated as paid evenly throughout the year. That's a huge tool to your advantage. Now, this is not advice for everyone, and be sure to work with your CPA to dial in the right amount or with your financial advisor. Now, what if you're a charitably inclined and over 70 and a half? Consider a QCD. We've talked about it in other videos. A qualified charitable distribution sends IRA dollars directly to a qualified charity. The amount you give does not show up in your taxable income. For IRA owners who already give, QCDs can satisfy part or all of an IRA RMD and may reduce Medicare surcharge risk. The charity must be eligible. The transfer must go directly to the charity. Keep your receipt. This tool helps many generous families across the United States lower taxes without changing their giving. So let's go ahead and handle two common objections we hear. First, markets could drop. Shouldn't I delay the first RMD to give my account more time? Well, market moves are real, but the RMD is a percentage, not a fixed dollar amount. The bigger risk is stacking two RMDs in 1 year and paying more tax than necessary. Often, the better answer is just to take one RMD this year, one RMD next year, and manage your investment mix so you have cash and bonds ready for withdrawals. Second, I do not need the money. Can I just skip it? Well, skipping an RMD can create penalties and headaches. If you realize a miss, talk to your custodian and your tax pro quickly. You may be able to correct it and reduce the penalty if you act fast. But the easier plan is just to go ahead and schedule the withdrawal on time and decide where to place the cash. You can always reinvest a taxable account or reinvest it into a taxable account if that fits your game plan. Now, let's go ahead and bring it together with a quick decision map for our viewers. If you turn 73 this year and next year's income could be high, take the first RMD this year. If next year includes a business sale, a Roth conversion, or large capital gains, avoid stacking two RMDs on top of that. If you plan large giving, consider using QCDs to satisfy part of your IRA RMD this year. If you are still working and your plan allows the still working exception, be sure to confirm whether you can delay plan RMDs. But remember that IRAs still require them. Now, here's a short recap you can remember. First, do not create a 2-in-1 year problem. Taking the first RMD in the year you turn 73 often smooths taxes out. Second, coordinate taxes, Medicare, and giving. Use withholding estimates and QCDs to keep income steady for you and your family. Third, follow the account rules. IRAs aggregate, 401ks do not. Set reminders and avoid penalties. So that's it. If this was helpful, please like this video and subscribe for weekly retirement strategies tailored to high net worth households just like you. And if you want help pressure testing your plan, you can go ahead and click on the link down below to get your free retirement assessment. We'll cover the topics in this video and also help you get on track for retirement. If you want free checklist to help you think through different areas of retirement, again, click on the link below and you can download our free retirement checklist library where you'll be able to get some good information and guidance there. Otherwise, appreciate you joining. Have a good week. Bye.